Japan, 1991. Asset bubble bursts. Property crashes. Consumers stop spending. Prices fall. People wait for prices to fall further. Prices fall more. That loop lasted 30 years. Now look at China. 2026. Deflation. 10 consecutive quarters. Property investment down 50 to 80% from peak. Youth unemployment at 16.9%. Retail sales growth near a 40-month low. Beijing has cut interest rates, pumped fiscal stimulus, launched trade-in subsidy programs, told banks to lend more, and Chinese consumers are still not spending. This is not a demand problem that stimulus can fix. This is a psychology problem. When your apartment, your single largest asset, has lost 30% of its value, and your neighbor just lost his job, you don't spend, you save, you wait. The question isn't whether Beijing knows this. They do. The question is, why can't they break the loop? That's what this video is about. Let's start with the numbers. Because the numbers are brutal. China's GDP official growth rate for 2026, 4.5 to 5%. That's the headline. That's what Beijing reports. That's what makes international investors say, China is fine. But here's what's underneath that headline. Producer prices, the prices factories charge each other, have been falling for over 30 consecutive months. Not slowing, falling. Month after month after month. That's deflation embedded deep inside the supply chain, long before anything reaches a consumer. Consumer prices? Flat. China's inflation target is around 2%. In 2025, actual consumer price inflation was essentially zero. Core inflation, stripping out food and energy, was 0.7% for the full year. Retail sales growth is near a 40-month low. Private investment declined 2.6% year-on-year, continuing a contraction that started in June of last year. Youth unemployment, workers aged 16 to 24, hit 16.9%. And property investment, the sector that for 2 decades was the engine of China's growth, declined 17.2% in 2025 alone. From its peak, property investment has collapsed between 50 and 80%, depending on the metric. These are not the numbers of an economy growing at 5%. Electricity consumption, freight volumes, tax revenues, the indicators that are harder to manipulate, suggest actual growth is closer to 3 to 4%. But the growth rate is almost beside the point. The deeper problem is this. China is producing more than it can consume, and it cannot find a way to close that gap. To understand why Chinese consumers won't spend, you have to understand what Chinese consumers own. For the average Chinese household, property is not just a home. It is the primary store of wealth. In many cities, 70, 80, even 90% of household net worth sits in residential real estate. At the peak in 2020 and 2021, Chinese households had poured decades of savings into apartments. Not just one apartment. Many middle-class families owned multiple properties as investment vehicles because there were few other options. Stock market? Too volatile. Foreign investments? Restricted. So property became everything. Then the collapse came. Property sales have fallen 65% from their 2020 peak. New home starts are down over 70%. Millions of apartments were sold. Deposits were paid. Construction began and then stopped. These are the unfinished homes. Liabilities sitting on the books of developers like Evergrande, Country Garden, and dozens of others that have defaulted or restructured. Estimates suggest between 20 and 30 million unfinished apartments are still waiting for delivery across China. For the families who paid for those apartments, their savings are locked in concrete shells. No rental income, no resale value, no completion date. And even for families whose apartments were completed, values have dropped. In most Tier 2 and Tier 3 cities, property prices are down 20 to 40% from peak. In some smaller cities, the declines are steeper. When your primary asset loses a third of its value, You don't feel rich anymore. You feel anxious. And anxious people don't spend on restaurants, vacations, luxury goods, or new appliances. They save more. That is the deflation trap in one sentence. Falling asset values create precautionary savings. Precautionary savings reduce demand. Reduced demand causes prices to fall further. Falling prices cause asset values to drop more. The loop feeds itself. Beijing is not blind to this problem. Chinese policymakers have known about the deflation risk for years, and they have tried, repeatedly, to break the loop. Let's go through what they've done. Interest rate cuts. The People's Bank of China has cut rates multiple times. Mortgage rates are at historic lows. On paper, it has never been cheaper to borrow in China. But here's the problem. When you expect prices to fall further, low interest rates don't encourage borrowing. Why take out a loan today to buy something that will cost less tomorrow? Rate cuts are a tool for a demand-constrained economy. China's problem is a confidence-constrained economy. Different disease, wrong medicine, fiscal stimulus. Beijing has issued special bonds, funded infrastructure projects, and directed state banks to lend more aggressively. And this has worked, but only in one direction. Infrastructure spending, state investment, and export-oriented manufacturing have all received a boost. Industrial output grew 6.3% year-on-year in early 2026. Factories are humming. But the output goes where? Not to domestic consumers. To export markets. China's trade surplus hit a record $1.2 trillion in 2025. Another record is likely in 2026. The economy is producing at scale, but the production flows outward, not inward. Trade-in subsidy programs. Beijing launched consumer subsidy schemes, incentives to replace old appliances, old cars, old electronics. These generated short bursts of retail activity, but the effect faded quickly. Subsidies pull forward demand. They don't create new demand. Once the subsidy expires, consumers go back to waiting. Capital injections for banks. The government has injected capital into major state banks to strengthen their balance sheets and encourage lending. But banks are already sitting on rising non-performing loans from property developers. They are not eager to extend new credit to consumers with uncertain income and declining assets. Every tool Beijing has used addresses the symptom. None address the cause. And the cause is not that Chinese consumers lack money. China's household savings rate is among the highest in the world, around 30% of income. The money exists. The problem is that people don't trust the future enough to spend it. So if the money exists and the tools exist, why can't Beijing break the loop? The answer lies in something economists call a liquidity trap. But in China's case, it's more specifically a confidence trap. Think about what shapes consumer behavior. It's not just current income. It's expected future income. It's perceived wealth. It's trust in institutions. It's belief that tomorrow will be better than today. In China right now, all of those signals are pointing in the wrong direction. Your apartment is worth less than it was 3 years ago. Your company may be cutting costs. Your city government is running a deficit and delaying pension payments. Your children are graduating into a job market with 16.9% youth unemployment. In that environment, every rational decision points towards saving more, not spending more. And here is the structural problem Beijing cannot solve with policy alone. China never built the safety net that would allow people to feel secure enough to spend. In the United States, Germany, Japan, countries with aging populations and deflationary pressures, citizens have national pension systems, universal health care, and unemployment insurance robust enough to cushion economic shocks. People can afford to spend their savings because they trust the system to catch them if they fall. In China, healthcare costs are high and unpredictable. Pension coverage outside major cities is weak. Unemployment protection is limited. So households self-insure. They hold cash. They hold savings. Because the state safety net has gaps they cannot afford to fall through. This is the deepest structural problem, and it cannot be fixed with a rate cut or a subsidy program. It requires decades of social spending, institutional trust building, and wealth redistribution that runs directly against the model Beijing has used to grow for 40 years. The model was suppress consumption, maximize investment and exports, accumulate foreign reserves, build infrastructure, develop industry. That model built the world's second largest economy. And that same model is now the reason Chinese consumers won't spend. So what does this mean for the rest of the world? It means China's deflation doesn't stay inside China. When Chinese factories produce more than Chinese consumers can absorb, that excess production gets exported at prices that undercut local manufacturers in Europe, Southeast Asia, Latin America, and Africa. Chinese steel, solar panels, electric vehicles, electronics, flooding global markets at margins that domestic producers cannot match. That's why the European Union has imposed tariffs on Chinese EVs. That's why the US has launched new trade investigations across 22 manufacturing sectors. That's why emerging markets that once hoped to benefit from China's growth are now watching their own factories close. China's inability to stimulate domestic consumption is not just China's problem. It is a structural export of deflation to every economy connected to global trade. For investors watching supply chains, for policymakers watching trade balances, and for anyone trying to understand where the global economy is heading, the question of whether Beijing can finally break this loop is one of the most important questions of the next decade. We'll be tracking every data point as it comes. If this analysis was useful, subscribe. And if you want the deeper data, the weekly breakdown, the charts behind the numbers, the link to our Substack is in the description. This is China after the boom.